You know that feeling when you see a really successful, well-known company and you think, man, that has got to be a great stock to own? It's a super common thought, but honestly, it can be a dangerous trap for investors. Today, we're going to dig into why that is, using one specific company as our guinea pig, CDW. We're asking a simple question, but the answer, well, it's a little more complicated. So let's just start with a big question right up front. Is a great company always a great investment? I mean, it feels like the answer should be a simple yes, doesn't it? But as we're about to see, the stock market just doesn't work that way. The quality of a business and the quality of an investment can be two completely different things. To really get to the bottom of this, we're going to put a real-life company under the microscope, CDW Corporation. They're a huge provider of IT solutions, they're well-respected, a leader in their field, all that good stuff. But the question remains, does that make their stock a buy? Now, to guide us through this, we're not just going to wing it. We're going to use the legendary four-part framework from one of the greatest investors ever, Warren Buffett. We'll look at the business, the management, the financials, and finally the price. Think of it as our investor's checklist. So let's dive into test number one. First up, the business itself. Buffett is famous for loving companies that have a strong defense against their competitors, something he calls an economic moat. So the first question is, how does CDW stack up? How strong is its defense? So what exactly is an economic moat? Well, think of a castle. A moat is what protects it from being attacked. In the business world, it's some kind of durable competitive advantage that protects the company's profits from getting eaten away by rivals. This could be anything from a powerful brand to a unique technology. It's the company's defensive wall. All right, here's our first report card for CDW. As you can see, it gets a couple of nice green check marks. The business is pretty simple to understand, and it's been consistently strong for decades. That's great. But look at those bottom two rows. The competitive advantage gets a warning flag. Why? Because while CDW is big, it doesn't really have a unique product that no one else can copy. And that leads directly to the last point, limited pricing power. They're basically a reseller, which means they're kind of squeezed between their suppliers and their customers. So the verdict on the moat? It's there, but it's not exactly the fortress Buffett loves to see. Okay, so the business is solid, but it's not invincible. That brings us to our second big test, the people running the show and the story the numbers are telling us. Who's in charge, and are the financial books as good as they seem on the surface? And on the surface, the management team looks pretty solid. They get good marks for integrity and for being smart with their money. You know, they're not out there chasing the latest fads. They stay focused on what they do best. But you see that little but in there? There's a key part of their financial strategy that makes you raise an eyebrow. And to understand that, we've got to look closer at the numbers. Okay, now look at this number, 200%. This is CDW's average return on equity. To put that into perspective for you, a truly fantastic business might hit 20 or maybe 30%. So this number is it's almost unbelievably good. It's the kind of number that makes you stop and ask, wait a minute, how is that even possible? And here's the secret sauce. This slide explains everything. That incredible 200% return isn't magic. It's being propped up by a mountain of debt. It's something called financial leverage. Think of it like this. You can use a small amount of your own money to lift something really heavy, like profits. But that whole system is balanced on a very risky pivot point. It looks amazing when things are going well, but it makes any kind of downturn way, way more dangerous. So when we step back and look at the whole financial picture, it's a mixed bag, right? On one hand, the company generates a ton of cash, which is a huge, huge strength. But that's kind of offset by its thin profit margins and, as we just saw, a pretty high debt load. There are definitely real strengths here, but there are also very real risks. Okay, so this is it. This is where everything comes together. We know it's a good business with some real risks. But honestly, none of that really matters if we can't answer the final, most important question of all. What's this company actually worth? And what price is the market asking us to pay for it today? To answer that, we need another one of Buffett's core concepts, the margin of safety. Put simply, it just means buying something for less than you think it's really worth. It's like buying a dollar for 50 cents. That discount is your protection, your buffer, just in case your analysis is a little off or the company hits a rough patch down the road. So based on a deep dive into its cash flows and its business fundamentals, we can estimate that the intrinsic or fair value of a single share of CDW is somewhere around $220. Just keep that number in your head for a second. All right, so if the business is worth about $220, what is the stock market actually charging for it right now? Around $245. And just like that, our margin of safety has vanished. Yeah, instead of giving that discount we were looking for, we're actually being asked to pay a premium. We have a negative margin of safety, and what that means is there's no room for error. For this to be a good investment from this point on, the company can't just do well, it has to do everything perfectly. And that's a tough bet to make.
So, after running CDW through the whole Buffett gauntlet, we've looked at the business, the management, the financials, and the price. What's the final call? Is it a buy?
This one sentence really sums up our entire analysis. We've confirmed that yes, it's a well-run, solid company, a leader in its market. That's the good company part. But, and this is a big but, the market already knows this, and it has bid the stock up to a price that just doesn't look very attractive anymore. That's the poor price part. So what's the actionable takeaway from all this? Well, it kind of depends. If you already own CDW stock, this analysis suggests it's a solid company worth holding on to. But if you're looking to buy it today, the verdict is pretty clear. Avoid. At this price, the risk just doesn't seem worth the potential reward. That margin of safety just isn't there. And let's end on this final thought, which I think just perfectly captures the core issue here. Buffett loves businesses that are so strong they can survive bad luck or even a big management blunder. But with CDW's high debt and its pretty narrow moat, its room for error is much, much smaller. And without that margin of safety in the price, it's a risk that a classic value investor would probably choose not to take.